Hey, welcome back, options traders. It's hump day. Happy Wednesday to everyone. And I got another good question from one of the coaching sessions, and I thought it would be something that the rest of the group could benefit from. And the question is, when should you morph a butterfly spread? Now, we could also interpret the question to be, when should you morph a condor? Because they're basically cousins. They're sister strategies, and I'll talk about that as well. But the main point that I wanted to share is that whether we're talking about butterfly spreads or condors, traders almost always morph at the wrong times for the wrong reasons. So, when should you morph a butterfly spread? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always greatly appreciated. So to understand the idea of the morph, let's start off with a quick review of a butterfly spread. We've talked about these many times before, but remember, it's a strategy where you are going to build it with either all calls or all puts. Now, there is a version called an iron version that uses calls and puts, but the basic butterfly spread is built with either all calls or all puts. And what you're going to do, I'm just going to build one with calls. You're going to buy one call, you will sell two calls at a higher strike, and then buy one call at an even higher strike. So they're going to be equally spaced. You're just going to walk up that chain. They don't have to be based on what's available in the chain. So if you see them in the options chain at 2.5 points apart, you could certainly make them 5 points apart or 10 points apart. But whatever distance you choose, you want to keep that distance the same. Otherwise, you have a broken wing butterfly, and that's a separate strategy. So they all have to have the same expirations as well. But the key to note is that it's always in a 1 to 2 to 1 ratio. So we sometimes show that as 1 to 2 to 1, meaning that you're long the wings, that's why those are green, those are your long positions, and you're short 2 in the center. This is, of course, assuming that we're talking about a long butterfly spread. So for example, let's say that you buy one March $100 call, you sell two March 105 calls, and then you buy one March 110 call. So they're equally spaced 5 points apart in a 1 to 2 to 1 ratio. So if we put this strategy on here, this is the risk graph we would get. And let's say that it cost us $2 to buy this strategy. That would be the most that you could lose. And because these options are 5 points apart, we know that the most you could make would be 3. And that would be assuming that the stock is right there at that center strike. That's where we're getting that bend. So generally speaking, whenever you put the butterfly on, you would want to initiate it with the stock right here in the center. Now there are variations where we might choose to do a bull butterfly or a bear butterfly, where we will initiate it with the stock maybe on this side. That would be a bull butterfly spread. We would have some positive deltas over here, or maybe with the stock up here. We would have some negative deltas. That would be a bear butterfly. But generally speaking, you would want to initiate it with the stock pretty close to the center. Now, ideally, it would be exactly at the center, but again, in the real world, that's going to be unlikely that the stock is, in this example, exactly 105. But somewhere around here is where we would put the position on. Now, the morph is going to come if the stock makes a change. But let's do another quick review and take a look at what a morph is. So remember what a morph is. That's where you are going to open or close a position. In other words, you're either adding a new position to it, kind of adding on to it, or you're closing one of the existing legs in the position, and you're doing it to change the risk profile. You're doing it to change the shape of your risk graph. And the reason for doing it is that you are altering to either make it more or less risky. You're either trying to increase the chances for success or maybe trying to make it more speculative. There's a lot of reasons why we would morph a position. And again, in this video, I'm not really talking about the various reasons. I'm just trying to show you the time to strongly consider the morph for the butterfly. So for example, for the butterfly, we can view it as two vertical spreads. If we buy the 100 call and just look at short one of the 105 calls, that would give us the green vertical spread. We could also take the second of those short 105 calls, paired up with this long 110, we would have the credit spread here in red. So this might be one reason to do a morph. I've gone from a butterfly spread and I want to maybe go to the debit spread or the credit spread. Maybe we think the stock is about to run out here. We don't want this area of loss out here with the butterfly spread. So again, that's just a little background of why we might morph and what it means to morph. So this is our butterfly spread that we saw, buying the 100 call, selling 2 of the 105s, and buying the 110. And the thing that you have to realize, this is really the big point of the video. The second that you put this strategy on, you have to have the right perspective. The stock is not going to stay at 105. In fact, it is highly unlikely that it's going to stay there. The strategy is more of a volatility play. It's more of a race against time play. It's a positive theta play. There's a lot of different reasons why we put it on. But you shouldn't put this position on expecting the stock to sit right here at 105. That's why traders usually lose with butterflies, because the second that that stock moves slightly off of 105, and it's going to do that, they either want to shut it down or morph it somehow. So remember, with, let's say, with 20% volatility, if this butterfly spread has 30 days to expiration, that bell curve looks like this. Current stock price is right here at the height of that curve, right at the center. And at 20% volatility, that means we could expect about a $6 move up or down in 30 days. So 68% of the time, that's a 1 standard deviation move, that stock is going to be in this green area. That should be your overall expectation. It's not going to be at 105. It's going to be somewhere in the green area. Now also remember, we don't need the stock to be at exactly 105. That's just where we make maximum gain. We really need it to be either above this lower break even or below the upper break even. So if we paid $2 for it, this lower break even is the 100 strike plus 2 or 102, or the upper strike 110 minus 2, which would be 108. So that's a fairly big range. 102 to 108 is really where your expectations should be. But the thing that I want to really stress, for most traders, most of the time, you really shouldn't be considering a morph until the stock gets out here towards the strikes of one of these wings. And are there exceptions? Of course. If you have big news that has changed your outlook, that could certainly be one. Maybe it's broken through a technical point back in here and you definitely want to morph. But outside of any news or major breaks in technical indicators, you don't morph just because the stock has moved somewhere inside of this range. That's totally expected. So think about just challenging the stock. Just because it may have broken outside of this area up in here doesn't mean that it's got to stay there. Stocks can reverse. So be willing to hold it for, even if it's just a day or two, up into here. So maybe if the stock is at 107 or 108 and it sits there for a while or maybe continues to climb, yeah, I would probably think about morphing it up in this range. So the main thing to understand is that it's okay if the stock price drifts away from this center. It's expected to. Don't morph just because the stock has moved $1 or 2 or 3 away from the center. Now we get the same idea with the condors. Remember that a condor is the sister strategy. Basically, we're going to construct them with all calls or all puts. Just like with the butterfly, there is an iron version that is built with calls and puts. But your basic condor uses all of one or the other. So for example, you might buy one March 95 call, sell a March 100 call, sell a March 105 call, and then buy a March 110 call. So notice that just like with the butterfly, you are buying the wings. You're buying the lowest strike and the highest strike. But instead of selling 2 of the same strikes in the center, you're splitting them. And by splitting the strikes in the center, we get this flattened portion off the top. And that's what gives us a wider range of potential stock prices to move to still make maximum gain. Now remember, we've talked about it from risk and reward videos before. Yes, you have a higher probability for success, and that means that you are going to pay more for the condor. The reward will be lower. But just like with the butterfly, you want to wait for the stock to break out of these short strikes. Don't worry about the fact that it's in between. So maybe if it's up in this range here on the left side, on the downside, or in this range up here on the right side, in both cases they are either above or below these short strikes. But again, the main point is don't morph it just because it has moved somewhere off of dead center. You've got to realize that is what's expected to happen. So that's not the reason for the morph. Now, yes, there's a ton of exceptions, but I'm just talking about under normal volatility, stock price moving up or down. I find that traders tend to morph too often. They're just trying to jump on it too quickly because they don't have the right expectations. So the main thing to take from this video, don't morph just because the stock has slightly moved from the center. You should expect it to. Instead, morph when there's either a significant change in the news or if the pricing has changed in such a way that it gives you an edge in the position. Morphing for the right reasons and the right times will give you better chances for success. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis class. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.